is not under a FHA 203K, the house has to be in good livable condition. So I touched a little bit on this on the last video. So now that I'm in a better space now, I want to try to re-tap into it again because I have some notes to refer back to, and I can be a little bit more structured with my approach. So we're going to go over different types of home buying. I'm going to briefly cover FHA. I'm going to cover conventional. I'm going to cover hard money. I'm going to cover asset lending. I'm going to cover buying a house with credit cards. I'm going to cover using investors to buy properties, and I'm going to go over seller's finance. Okay, the first thing we're going to talk about is the FHA loan. So the FHA loan, FHA stands for the Federal Housing Administration. So basically the Federal Housing Administration makes sure that housing is affordable, that there's no redlining going on. They're just a part of the government that oversees how housing is provided and the affordability and the laws being followed, stuff like that. So none of that matters. What does matter is how do you qualify for an FHA loan, right? And there's two different types of FHA loans. There's a regular FHA loan, and then there's a 203K FHA loan. So you have an FHA loan, and then you have an FHA 203K. So I'm going to explain the difference in a little bit. So let's talk about some of the ways you qualify for this loan. So one benefit of this loan is that you only have to put down 3.5%. So that means if you wanted to buy a house that was $100,000, you will only have to put down $3,500. Now here's the thing with that, right? Even though you only have to put down 3.5% to get the loan, there are other fees associated with getting the FHA. For example, PMI. PMI stands for private mortgage insurance. So pretty much what that is, it's insurance on you defaulting on a loan, only because that there's not really that much equity in the house. So the banks have to take out an insurance policy to cover themselves. Now, the bank doesn't pay for it, you have to pay for it. So the PMI gets factored into the cost. And then not only just that, you gotta factor in taxes, any type of like document fees, stuff like that. And then not to mention your inspection. So before FHA approves a house, you have to get an inspection. The reason they do the inspection is because they want to make sure that they're not giving you a loan to buy a bullcrap house. Now, with an FHA 203K, they will give you money for a messed up house. But in this case, if you're buying a house that is not under a FHA 203K, the house has to be in good livable condition. So that inspection alone is $500 per house. So that's why you really want to make sure that the house you pick is the house you want, because if you pay for that inspection and it fails inspection and you decide not to go forward with it, you don't get that $500 back. That $500 is gone. Transferring taxes, that goes without saying. PMI, sometimes they factor it into the mortgage amount, like what you pay monthly, or sometimes they put it in a down payment. It all depends on how the deal is structured. But these are all extra costs that can come in when you're going to close on a property. So I tell people, even though by FHA standards, the down payment is 3.5%, I tell people to have a mindset. That you're putting 5% down. Because if you put 5% down, you're covering all those other miscellaneous fees that can come up. So yes, FHA is 3.5%, but since there's extra taxes and fees and miscellaneous stuff, you want to just round it up to 5%. So whatever type of house you're looking to buy, just try to have in your mind, you're going to have to put out 5% of your money, of the money to get there. So now we covered what you need as a down payment, right? And there's a lot of ways you can save up a down payment. This is some ways you can save up from that down payment, right? Getting a roommate. Listen, I had people that was to the point where they wanted to pay me $100 a week just to sleep on my couch. But guess what? If someone's giving you $100 a week, right? If you multiply that by 52 weeks in a year, that you now have towards your property because you got a roommate. So that's one way, right? Uber, Lyft, Postmates, pretty much all those little, delivery services, stuff that you can just hop in. Only thing you need is a car or a method of transportation. You can make some money. Now, people sometimes front on companies like this when it comes to making money, but guess what? I know Lyft and Uber drivers that part-time make an extra $3 to $4 grand a month. Make an extra $3 to $4 grand a month. So that's another thing that can add into you saving for your down payment, right? Another way is first-time homebuyer programs. So with first-time homebuyer programs, usually it comes in a form of like a class or like a seminar or something you have to go to. Your local realtor will know more about these programs in your area because we all live in different areas and there's different areas offer different programs. But in almost every area, there's some type of first-time homebuyers program where for completing their program, they'll give you anywhere from $500 to $5,000 towards your closing costs when you go to purchase your property. So that's another thing you should look into. If you're looking for a realtor, if the realtor doesn't know about any first-time homebuyer programs, they're not a good realtor. Any experienced realtor should know about the homebuyer programs in your area. So that's something you should keep in mind. Another thing you can do to save up money for your down payment is doing surveys. So surveys are stuff you can do online to make an extra $20, $40, $50. There's actually, you can actually go on Google right now and Google local surveys or local or focus groups. Sometimes you can get paid $100, $200 to go to a focus group. A focus group is basically when they take a group of people that are at a certain age or they meet certain requirements. Maybe you smoke, maybe you're pregnant, maybe your mother, whatever. And they pretty much just ask you questions and ask you to test out products, stuff like that. So that's another way you can make some extra money, doing surveys. So another thing you can do to make some extra money is utilizing Upwork and Fiverr. So Upwork and Fiverr are pretty much freelance services that you can provide. So let's say, for example, you know how to edit graphics, you have customer service skills, you know how to cold call, or anything. You can be a virtual assistant. You can type up stuff for people. Whatever skills that you have, you can put these skills on Upwork and on Fiverr, and then people in the marketplace will come find you and pay you money for your skills. So just understand, the more skills you have and the better you are at those skills, the more you can charge and the more money you can make off of something like that. So that's just something to keep in mind. Another thing is stock trading. Now I know that scares a lot of people because they think it's hard, but it's really not. I feel like it's hard to find the right strategy, but once you find the right strategy, trading stock is easy. So the stock of my choosing is actually in a foreign exchange, so it's in Forex. So my favorite thing to do is trade something called US 30. Trade US currency. So basically, when I'm trading currency, what I'm doing is I'm taking something small like $100 or $20 or something like that. And what I'm doing is I'm watching the market to see when it's the best time to exchange the currency for another currency. And whatever the difference is the profit that I make in between. And the reason why I pointed this out, because this is something you don't need a lot of money to do. If you have $500, you can make your down payment in Forex. I've done it plenty of times. I actually got into Forex when the pandemic came in. I toyed around with it before, but I never really took it seriously. And what made me take it seriously was because when the pandemic came, I didn't know how that was going to affect my business. I have a credit repair business, and I didn't know if the credit bureaus would get shut down, which can affect my income. So then I linked up with a mentor. He taught me the ketchup mustard strategy, where basically my chart is pre-set up for me, and it tells me when to get out of trades and when to get into trades. So that's another thing you do to make money. They save up for your down payment. And if you want more information on this stuff, just shoot me a message, and I'll get you the information on it. Let's say you made the money. You say, Aaron, I made the money. I got the down payment. Now what do? You need 2 years of tax returns. So if you're someone that hasn't been filing taxes or something's wrong with them, all you gotta do is get with an accountant. Your accountant can backtrack your taxes for the last 2 years so you can be able to get a mortgage. And if you need an accountant to help you out with that, I have an accountant that helped me with the same situation. He can file your taxes for you, make sure you have the tax returns to provide. And sometimes it's smart, if you're about to buy a house, to claim a little bit more on your taxes, because the more money you make controls how much house you can buy. Your credit determines the interest rate. So let's just go over that. Credit. So income determines the amount you can get, while credit determines your rate. So if you want to be able to afford more house, you either have to put down a bigger down payment, or you'll have to claim more income on your taxes. So talk to the accountant to see what works best for you. All right. You also need at least a 640 to a 660 credit score. Especially now during the pandemic, 60 is probably like the mandatory one, because it's usually 40. It's usually a 640, but when the pandemic kicked in, the banks got scared and they started raising a lot of the requirements. So that's why I'm gonna say between 640 to 660. So if you're in this range and you have 2 years of tax returns and you have your down payment saved up, you are now ready to buy a house. But guess what? There was another thing about getting the down payment I didn't mention. Because you might have the credit score, you might have amazing credit. You might have amazing credit, you might have your 2 years of tax returns, but you might have issues getting that down payment up. So then what you can do is you can start an LLC. You add it with your good credit. You can get a business line of credit. You can then take money from this business line of credit and put it towards your down payment. And then with a lot of business lines of credit, you only have to pay 5% of the balance every month. And not only that, a lot of them offer you 0% interest for the first year. So the reason why I say get the LLC first, because if you have good credit and you get an LLC, you can apply for a business line of credit, and the banks, when they go to get you the mortgage, will only see things that's on your personal credit. But once you get an LLC, the LLC is like your smoke screen. With that LLC, any credit or any debt that you have behind that LLC, no bank can see unless they're checking your business credit, which none of them don't for a mortgage. So the mortgage, since they're only checking your personal, you can sneak over here, get this LLC, use your good credit, get approved for a business line of credit. Now you only got to pay 5% of the balance every month, and you probably won't have 0% interest. You use that for your down payment. Then what you can do is After you paid your mortgage for, like I say, a year or two, let's say 2 years, you can refinance. Or if you don't want to wait 2 years, you can do some updates or some repairs to your house, right? And you can refinance. And then when you refinance, you can then pay off this line of credit where you refinance. Because when you refinance, you're pretty much getting a loan for a higher amount because your house is now worth more, or you have more equity in the house because you've been making monthly payments. There's another company called Unison. So Unison is a company that pretty much, for exchange of equity in your house, they'll give you the whole down payment. So they'll basically say, hey, Aaron, we want to get 20% of your house appreciation. In return, we're going to give you $10,000, $15,000, $5,000 towards your down payment of your house. Now, in some situations, it's worth it. Some situations, it's not. That's why you really got to look at the numbers and make sure it makes sense. So it's called Unison. That's the name of the company. Another thing I'm going to cover, right? Another thing I'm going to cover is the FHA 203K. Now, it's the same requirements as a regular FHA. However, with this, they will allow you to buy a fixer-upper. So what I would do with an FHA 203K is that I will find a multifamily or a house that you can turn into a multifamily. A multifamily is one house that has multiple units. So one house can have 2 or 3 different families living in there. That's a multifamily. So I will use this money, turn a property into a multifamily. I will live in one, and then while living in one, I can then rent the others. And now not only am I living for free, I'm now able to make an income. So with an FHA 203K, you can get up to 4 units. Or you can rehab the property into 4 units. So I say go for it all. Go for the 4 units. Minimum, go for a triplex. Because a duplex might just pay your mortgage, but once you get a triplex and a quad, that's now 2-3 rents. They're now contributing to the mortgage, and then that's how you start making some extra money on the side. So try to find properties in areas that people want to live in so you can get the highest rents and get best quality tenants. So I just went over the FHA, which is the Federal Housing Administration loan. I went over the 203K. So I'm going to end this live right now, and I'm going to do another one on conventional lending and hard money lending.